All right, so I recorded a video on Royal Caribbean Cruise Line on April 10th, 2025. And at that time, the stock was trading at around $190 a share. And I recommended the stock as a buy, but it was one of those situations where there was a catalyst, there was an opportunity, and I highlighted the opportunity with the company's long term debt and reducing that debt, lowering interest expense, and increasing profits. Since then, Royal Caribbean's stock price has increased from $190 a share to $233 a share as of this recording. So if you listened to that recommendation and you made some money, congratulations. I'm always happy when one of my recommendations makes my viewers profits. But I'm going to revisit Royal Caribbean stock in this video, evaluate the company's longer term risks, update my proprietary discounted cash flow valuation model, and let you know if I still think the stock is a buy at these higher valuations. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so one of the bigger risks with Royal Caribbean is illnesses, right? Health and safety risks. And this wasn't just with the COVID outbreak, which was severe on cruise lines during, of course, those times. In 2024, the CDC tracked 15 disease outbreaks on cruise ships, including incidents on Royal Caribbean vessels involving norovirus and salmonella infections. And this has been a common thing with cruise ships is people get sick more often on cruise ships than with many other types of travel. Of course, people get sick when they travel a lot, when they visit new places and eat new foods and expose themselves to new situations. But it's been a little bit more severe with cruise ships. All right, the next risk I'm going to highlight is geopolitical and economic risk. Royal Caribbean has identified macroeconomic and political factors as significant risks. And right now, especially, there's heightened macroeconomic and geopolitical risk following President Donald Trump's tariffs on the United States trading partners. There's been evidenced slowdowns in macroeconomic activity, and travel, especially cruise travel, could be hurt as a result. I've already seen several data points where travel demand is slowing from Airbnb and bookings holdings. Another big risk for Royal Caribbean is debt. The company has substantial debt, and this is high cost debt. Most of Royal Caribbean's debt came during the pandemic when the company had to pay very high interest rates for that debt. And now, if there is a significant slowdown in bookings and profit for the company, that debt could weigh on the company more so than usual. And finally, operational and supply chain risks. The challenges in sourcing crew members and supplies for certain regions can disrupt operations for Royal Caribbean. Also, delays in ship construction or maintenance can affect availability. And it's uncertain how the increase in tariffs are going to impact the company's operations. I'd be interested to hearing more about the company's management team and how its implications are related to the tariffs. Right. So now that we talked about risks, I wanted to share with you my proprietary discounted cash flow valuation model. And I calculated an intrinsic value per share for Royal Caribbean at $208. Now, the current market price has increased by so much that it's well above the intrinsic value at $233. And this is even after I account for a 10% margin of safety. It's still above that current market price compared to intrinsic value. Even after accounting for a 10% margin of safety, the stock now looks overvalued. And I mentioned the debt. The company has over $20 billion in debt, and most of that came during the pandemic, so it's high cost debt. But I also mentioned that the company is expected to generate very strong free cash flow between now and the very long run. So it can use that cash to pay off the debt. And that was one of the reasons why I recommended the stock as a buy when it was trading at around $190 a share. And it was below the intrinsic value calculation. And also when I measured it on a forward price to earnings, which I like to go to finchat.io to retrieve the forward price to earnings ratios. There's a link in the description for a discount to finchat.io. But about a month ago, when I recommended the stock as a buy, it was trading at a forward price to earnings of around 11 and a half. And that has gone up significantly. So the valuation has gone from a forward PE of around 11 and a half to 15. So the valuation has also gotten more expensive, both in terms of the forward price to earnings and in terms of the discounted cash flow valuation. So overall, this business has become, uh, for new investors, it's become a lot less attractive than it was a month ago when I last visited the company and I did my recommendation and I recommended the stock as a buy. So to update my Royal Caribbean Cruise Line recommendation, I had it rated as a buy and I'm going to slightly downgrade it today to a borderline buy. So this, for me, this category, I give companies a borderline buy when they're between a buy and a hold, but closer to a buy. So I give them a borderline buy rating, and I'm updating that recommendation on May 9th, 2025. The company still has many positives, including the robust free cash flow expectations between now and the very long run, which they can use to pay down that debt, which when they pay down that debt, that will lower their interest expense, which will create more free cash flow, which they can use to pay down more debt. And that positive virtuous cycle can go on for many, many years because they have over $20 billion in debt. They're generating two, three, four, five, $6 billion every year. So it'll take them, even if they use all of their free cash flow to pay down their debt, it'll take them at least 5, 6 years to pay down that debt. Now, I know they don't want to pay down all of that debt. They want to hold some strategic debt because it lowers the overall cost of capital, but they will want to pay down some of that highest cost debt, which they can do over these next few years and increase free cash flow as a result of the lower interest expense. However, the valuation has increased substantially in the last month and a half since I visited the company. So I'm just downgrading the company a notch from a buy down to a borderline. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.